policy coordination, at which we were joined by our non-Euro partners and friends, and also joined by Aurora Laluc, the chair of the European Parliament's Economic and Monetary Affairs Committee. We're all aware of the background to this discussion, the change that is happening within the global economy, and today there was yet again broad agreement on some fundamental principles. First, all finance ministers agreed on the need for a unified stance and approach in response back to the change that is underway. Secondly, continued agreement on an appropriate policy mix within the euro area that responds back and protects and adjusts within our economies, but also safeguards the long-term strength of the euro. Thirdly, that this mix be guided and be anchored within the framework of the work that we have all done on our budget rules. And then finally, all of those projects that we have been committed to and making progress on over recent months and years, the need for them to be approached with an even higher level of urgency. Whether that is our work with regard to the digital euro, whether it is now the really important agenda of an investment and savings union, or whether it's the broader work of the European Union with regard to trade diversification, and then respecting and supporting the work that the Commission is doing in responding back on our behalf. We all agreed that it is very important to keep track of how the shifts that are taking place translate into economic sentiment, into activity, into prices, and we factor all of this into what it means for the euro area's policy mix. We're clear on where we stand within Europe. We remain united to a rules-based way of trading with each other, and we remain united in accelerating the progress that we have made on our greatest strength, our single market, and the way we economically cooperate with each other. We also, in our discussion here today, looked on other elements that are very, very important to our work, and many of those elements will now be picked up under the Polish presidency, and we look forward now to the commencement of their meetings here across the afternoon. Thank you.
Thank you, President. Commissioner Dombrovskis, please.
Yes, thank you. Good afternoon, everyone. Let me begin with our exchange on the economic outlook. The economic outlook is, of course, getting more and more unpredictable, and it's colored by the impact of Trump administration's imposition of universal tariffs on almost the whole world. We welcome the 19 days pause on reciprocal tariffs above 10%. It creates space for negotiations. However, we should not forget that the 10% reciprocal tariffs remain in place for almost all countries, and they represent a blow to the global economy. Furthermore, the US has not paused its 25% tariff on steel and aluminium, and also the 25% tariff on cars and car parts. The nature of these rapidly moving developments make it difficult to assess their impact on the EU's economic outlook. But what is clear, and what also ministers in today's meeting agreed on, is that the impact of the tariffs, it will be the US itself that will be first and most hit by the tariffs. The imposition of tariffs will weaken the US economy by reducing consumers' purchasing power, real wages, and making imported intermediate goods for production more expensive. Beyond direct effects on tariffs, however, the additional loss of investor confidence in the US economy would further aggravate its negative impact on GDP. According to our latest model simulations on the US tariff impact, US GDP would be reduced by 0.8 to 1.4% until 2027. The negative impact on the EU would be less than for the US, about 0.2% of GDP. if tariffs are perceived to be permanent or if there are further countermeasures, the economic consequences would be more negative, so up to 3.3% for the US and 0.6% for the EU and 1.2% for the world GDP, while the global trade would decline by 7.7% in 3 years' time. These model simulations do not account for additional loss of investor and business confidence in the US economy, which could further the negative GDP impact which I was outlining before. Of course, given the extraordinary uncertainty and rapidly changing tariff decisions, our model simulations cannot be fully precise, but they do show the overall trend that tariffs are damaging for the economy and for the prosperity. So let me make it clear, Europe did not start this confrontation and Europe does not want this confrontation. Tariffs go against the political and economic logic of deep and long-standing transatlantic trading partnership valued at 1.6 trillion euros in 2023, and this is the largest trade and investment partnership in the world. Global financial markets have already reacted badly to these developments with a massive volatility and sell-offs in recent days. So, from Commission side, we will continue to closely monitor financial developments in the days and weeks ahead. We are ready to negotiate a mutually acceptable outcome while defending our economic interests. So, there is no need to continue to hurt the US own and our economy. In fact, we have offered 0 tariffs for industrial goods. But of course, if needs be, we are also ready to respond with countermeasures to protect our interests, our people and our companies. At the same time, the EU will continue the work on deepening the EU's single market, enhancing our competitiveness and diversifying our trade with other partners. Given the overall challenging economic environment, we welcome Germany's infrastructure plan and reform of the debt brake. An increased investment in Germany could contribute to increase its growth potential and lead to the positive spillovers within the EU. So we look forward to receiving Germany's mid-term fiscal structural plan shortly after the new government takes office. We also held a short discussion on preparations for upcoming spring meetings of the World Bank Group and the International Monetary Fund. At this challenging time, the EU remains committed to rules-based international order and engaging with international partners through multilateral fora, including the G20 and G7. I will stop here. Thank you.
Thank you, President Lagarde. The floor is yours.
Good early afternoon. Dzień dobry. Dziękuję polskim organizatorom też na formalnej Rady ECOFIN w Warszawie. This is my very humble way to torture the Polish language, to say that we are all delighted to be in Warsaw. And for me to be back in Warsaw is a particular pleasure. So thank you to our Polish colleagues, thank you to the team that is supporting the Polish presidency. Everything has gone very, very smoothly, and the reception that was offered yesterday to all of us was really fascinating, gave us a chance to see the Copernicus books as well as quite a few other real attributes of Polish culture. I know it sounds a little bit unusual for a central bank governor to actually start with culture, but sometimes there is some specificities about Europe which have to do with culture and which should be preserved and secured. So I will not repeat any of the comments that have been made by my colleagues, which I support, and I would simply add a few numbers for your consideration, because our job at the ECB in a pre-monetary policy week, which requires that I be very quiet on any monetary policy-related questions. So that's just a warning for those of you who are going to ask me whether we're doing this or we're doing that. I'm not going to take those questions because it is a quiet period for us. But obviously we have to take into account the potential or already effective impact of tariffs on trade. And I will just mention 3 figures for you. The one that I will start with is the effective US tariffs that was applying to the euro area up until about a couple of weeks ago, which was 3.5%, which moved up to 3.8% under the currently applicable and soon-to-be applicable measures. So that includes the 10% across the board, that includes the 25% on the automotive sector and the oil and steel industry. And the third number that I will mention is 30%, which is the number that actually would be the effective tariffs in case there was the enforcement of those rules that have been put on pause. Now, with that, I will simply say that the European Central Bank is monitoring and is always ready to use the instruments that it has available and has come up in the past with the adequate instruments and tools that were necessary in order to procure price stability and, of course, financial stability, because one doesn't go without the other. But don't be disappointed if I don't answer your questions, no matter how circumvented and sophisticated they are in order to make me say things that I will not say. Thank you.
Thank you, President Lagarde. Managing Director Romania, the floor is yours.
Dobry den. Thank you very much to the Polish presidency for a warm welcome here in Warsaw. It's a pleasure for me to be back. I will just focus on market developments in these turbulent times and obviously subscribe to all the things that have been said by President of the Eurogroup and Commissioner Valdis Dombrovskis just now. Let me start with the positive news, which is very difficult to find in these times of turbulences, and that is that the European financial system has shown substantive resilience in weathering drastic price movements. Despite market stress, euro area assets outperformed not only US peers but also those of other major economies. The announcement of a 90-day pause in reciprocal tariffs provided some relief to markets after the turbulence caused by the initial announcement of the 2nd of April. The tariffs announced initially were higher than expected by markets. They kept uncertainty elevated and spread doubt about the growth orientation of the government of the United States. In response, US equity markets fell significantly and ultimately long-term treasury prices as well, with the dollar depreciating. This is highly unusual in historical pattern. Usually, when US equities decline, US treasuries and the dollar trigger safe haven inflows. No surprise that markets showed a positive reaction after the moratorium was announced. From the perspective of markets, the pause of tariffs, the ones of the 2nd April, is a welcome respite. But, as was mentioned by Commissioner Dombrovskis, the damage that has been done cannot be denied and uncertainty remains high. This will slow down investment decisions and overall growth. Market participants remain concerned about the economic impact of the tariff barriers in place even after the pause. The additional tariffs on China and the open trade war between economies will have a meaningful cost for global growth, including for Europe. While tariffs generally harm global trade, markets expect the US economy to suffer most, and also more than Europe, as the models explained by Commissioner Dombrovskis show. Trade war between USA and China will impact growth in general for all of us around the globe. It is too soon to tell longer-term implications for the European economy and sovereign bond markets. Despite the good news of the 90 days tariff pause, uncertainty remains high. Some tariffs affecting Europe are meant to stay, even with the moratorium. First, tariffs on steel, aluminium and cars, and second, the 10% tariff across the board for all countries. For now, spillovers from US yields to euro area yields have been contained. In this uncertain environment, one thing is clear. Europe should seize the shift in the global economic order as an opportunity. We know in Europe what we have to do, as has been also highlighted by the two reports of Letta and Draghi. So Europe needs to deepen its single market, reduce its own barriers. Let's not forget that the most important share of our trade is amongst ourselves. It is good that Europe was resilient in these times, but what we really need to do is to boost our productivity. In these times of uncertainty and unpredictability, what we need is more unity. And what we've seen in the last couple of months is exactly that, unity. And I think the markets have recognized the very prudent approach of the Commission, and I think that has proved as being the right strategy.
Thank you. We open the floor for a few questions over here.
Thank you very much. Beda Romano, Il Sole 24 Ore. I had a question to Mr. Gramegna. You mentioned right now that there has been a fall in equities in the US and also treasuries and also the dollar. Diversification out of the US is something that has happened in the past. Do you see that this time around it is more structural than in the past? And do you see some advantages for the euro in general? Thank you very much.
Well, I'm not going to predict the future. I have just described the past. That's all I can say.
Thank you. Jorge, please.
Good afternoon, Jorge Valero with Bloomberg. First, a question for Mr. Donoghue, and maybe Commissioner Dombrovskis wants to reply as well. What we hear a lot over the past days is that there is a very strong sense of unity, but when we ask policymakers and ministers about the negotiations coming with the US or how to retaliate in case it's needed, we see differences. For example, some ministers said that we're open to discuss everything. Others say that we shouldn't talk about, for example, our tech rules and, of course, VAT. When it comes to countermeasures, President von der Leyen spoke about hitting big tech through this digital tax. Minister Cookie said that we shouldn't target digital services. So is that unity really exist? And, for example, what should we hit in terms of services when it comes to countermeasures? And for President Lagarde, in the past, you always called for that the fiscal side should do their homework, take their side of the responsibility when it comes to address different crises. This time around, we heard a proposal, for example, coming from Spain to set up an instrument, a tool to weather the consequences of the tariffs. I don't know if you will support such an instrument that could be financed, for example, with the duties. Thank you.
So in our discussion in the Eurogroup today, we had a very large number of ministers contribute, and every single one of them talked about the importance of maintaining unity, and acknowledged in maintaining unity it's also important that we engage with each other and we hear each other's views. And from the discussion that I have left, I am absolutely certain that we will work together to maintain total support for the work that the Commission are doing. I know the Commission will hear views, but I also know that as they engage with Member States, when they reach a view on what is the appropriate response back in dealing with this trade challenge, they will continue to receive the support of Member States in their work. We are in a negotiation. Because we're in a negotiation, I think it is appropriate to allow the Commission to do their work, to engage with Member States in private, and then when they outline what their agenda will be, for all of us to work together to find ways in which we can unite in supporting their agenda. And I'm certain that that is the approach that we will be able to generate in the time ahead. But of course, for all of us, we would rather not be in this situation. We would rather be in a situation where we were not facing such a trade challenge and difficulty, that instead negotiation would work, that we could engage with the US in a cooperative way and avoid the need for further measures in the future. But regrettably, if we do find ourselves in that situation, I'm confident that we will be able to maintain a unified approach from the EU in this and be able to support the Commission in their excellent work on our behalf.
If I may add a couple of things. Well, first of all, just to echo what Pascal has said, indeed there was a strong message of need for unity also coming out of today's meeting. But on this question on services, if I look our trade relations with US, we are actually we have a broadly balanced trade relations with US. Overall, we have a trade surplus maybe of 3-point-something% on the overall trade volume. But then if you look in the categories, we have substantial surplus in goods and substantial deficit in services. So when we are discussing the trade policy response, obviously we also need to look what is happening also on services side, including digital services. And as it has been outlined from the Commission side, when we are now discussing further countermeasures, all options remain on the table. So this is one point. And second point, obviously, when also the discussions were taking on retaliatory tariffs concerning the first steel and aluminium tariffs imposed by US, it's also a question, so to say, on a fair distribution of risks and potential economic pain across member states. There were, as you know, heated discussions on which sector should be included, which sector should not be included. So also from that point of view, we need to be united, but also we need to see that these risks are fairly shared among member states.
Thank you.
And shall I address the question?
Yes, of course.
So my response is not targeted to any kind of member state proposal, but the Governing Council has always held the view that joint fiscal improved capacity would be in order to respond to any kind of shocks. That's number one. Number two, you should expect the European Central Bank to focus particularly on what will improve European offers. And by that, I mean in particular the digital euro and whatever contributes to improved saving and investment union. We will focus specifically on supervision, better coordinated, more unified, better interpreted in a single way, and to the trading and post-trading infrastructure.
Thank you. Paula.
Thank you. Paula Tama with the Financial Times. President Lagarde, are you concerned at all about the sell-out of US bonds and treasuries? Is that potentially going to have knock-on effects also on EU obligations and equity markets? And then just a specification to Commissioner Dombrovskis, the figures and the estimates that you have given, is that prior to the pause? So that's assuming that the 20% retaliation is in place, or is that with the 10% and 25% on the specifics? Thank you.
So thank you for your question. We are monitoring carefully all market developments, and what we have observed recently, of course, is a degree of volatility. But in Europe and in the euro area in particular, we have observed that market infrastructures and the functioning of markets, including the bond markets, is functioning in an orderly fashion. I think that was essentially your question, right? Next one.
Yeah, on second question, The estimates I was giving were based on the 20% tariff assumption. Obviously, our experts are continuously updated those projections as trade policy continuously is evolving. Therefore, I would not now put so much emphasis, on exact figures or percentage points, because the situation will certainly evolve. Now we have this 90-day pause. We don't know what will happen after those 90 days. Are we having to have some success in negotiations? Are there going to be some further policy turns from the Trump administration? So there are many unknowns. But those estimates just give, as a broad feeling on the scale of the negative economic impact on US itself, on EU, on the rest of the world, so we more or less know what is this potential impact.
Thank you. One last question to Jan.
Thank you. Jan Strubczewski from Reuters. I have a question for Madame Lagarde. There is market talk about a Federal Reserve intervention in support of US Treasuries. Are you aware of any Fed intervention, and is the ECB involved in any way? And second question about the exchange rate of the dollar, which is changing very rapidly. I know the ECB does not target exchange rates, but it does matter in trade matters. So what is your view on the very rapid change of exchange rates of the dollar? Thank you.
Well, thank you for formulating the answer to your second question, because that is, in fact, the answer that I will give you, is that we do not target any exchange rate, but obviously we monitor and we are attentive to the impact that variation of exchange rates can have on inflation. So this is factored into the assumption and the calculations that we make and the models that are working on a very regular basis at the moment. On the first question, there is a regular dialogue between the key central bank presidents, chair and governors. But if I was aware of any such thing as you asked, I wouldn't tell you. Thank you.
Thank you. Thanks to everyone. Thanks to our speakers and to all of you for attending. And have a good afternoon, everyone.